Stop scrolling for a second. Silver didn't just go up, it changed behavior. We're talking fresh all-time highs, a clean breakthrough resistance that held for months. And here's the part that matters most. This isn't a slow grind you can casually watch from the sidelines. This is a sharp repricing, geopolitical stress, cracks in sovereign debt, erosion of confidence in currencies, all of it hitting at once. If you're holding silver, watching metals, or stacking physical, this move already affects your next decision, whether you realize it or not. Here's where most people get it wrong. They see price and think speculation. They read headlines about records and assume late-stage hype. They think, I'm late, this is probably the top. That's the wrong lens. Because the signals underneath the price, premiums, lease rates, warehouse flows, are whispering something very different. This isn't retail FOMO, buying dips on an app. This is institutional rotation colliding with physical stress. And if you can't tell the difference, the next pullback will shake you out right before the real move. Your job isn't to predict the top. Your job is to understand why price moves. So when volatility hits, you know what actually matters. If you're watching this now, you're already ahead of the crowd that'll chase headlines tomorrow. We're going to walk through 2 street-level patterns that repeat across cycles. Then I'll give you 5 concrete signals you can track this week. No theory, no predictions. Just the tells that separate people who see turns early from people who react late. All right, let's get into it. Quick pause before we go deeper. If you haven't subscribed yet, do it. We don't predict markets here, we prepare for them. This is for people who want to read stress before it turns into crisis. If that's you, you're in the right place. And drop watching in the comments if you're tracking metals right now. I want to know who's actually paying attention. So, here's what just happened. Silver pushed through the mid-30s, call it 34 to 36 depending on when you're watching, into fresh all-time territory. Gold is ripping too, but silver's move has been sharper, faster, more violent. That difference matters. When silver outpaces gold during a safe haven run, it's not just precious metals doing their thing. It's diversification demand, it's balance sheet protection, it's capital rotating out of growth stories and into hard assets. But here's the layer most people miss. Retail coin premiums are firm, not exploding, but steady. Physical dealers are reporting uneven availability. Lease rates, the cost to borrow silver in the paper market, are tightening, and warehouse stocks are seeing lumpy withdrawals instead of smooth, predictable flows. Think about that for a second. Price is what makes headlines, but the quiet tells, the stuff almost nobody watches, suggests this move is being funded by need, not hype. If this were pure speculation, those indicators would look very different. Let me show you why. There's a pattern that shows up again and again across commodity cycles. I call it the liquidity valve. Here's how it works. On the surface, paper markets stay liquid. Screens are green, futures trade smoothly, ETFs flow. Bids and asks look tight. Everything feels orderly, but underneath that, physical availability starts tightening. Premiums creep higher, delivery times stretch, warehouse draws get choppy. The real-world supply, the metal you can actually take delivery of, starts narrowing. Picture a valve. On one side, you have electronic liquidity, futures contracts, options, ETFs, massive volume, fast flow, seemingly unlimited. On the other side, you have physical metal, coins, bars, allocated storage. That's the valve itself, and it's much narrower than the paper flow. Most of the time, that valve handles the pressure just fine. Paper demand converts to physical smoothly, no stress. But when demand surges because of geopolitical fear, inflation hedging, or institutional accumulation, more and more participants want delivery, not just exposure. That's when the valve starts to choke. And when liquidity can't pass through, pressure releases the only way it can. Price jumps. Fast, non-linear. You don't get a polite 2% grind higher. You get a 6% rip overnight, a tight consolidation, then another leg. That's what silver is doing right now. This isn't a technical grind higher. It's price snapping through levels because the valve is tightening. Lease rates back that up. When borrowing costs rise, it means physical holders don't want to lend. Premiums back it up too. When retail coins stay firm instead of compressing towards spot, it tells you dealers can't source metal at old prices. This pattern isn't unique to silver. It showed up in crude oil when storage filled in 2020. It showed up in natural gas during Europe's energy crisis. It showed up in palladium when auto demand surged after lockdowns. Same mechanism every time. Paper markets look fine until physical constraints bite, then price gaps to clear the imbalance. Here's why that matters for you. When the valve is tightening, pullbacks don't behave like normal corrections. In a speculative move, dips cascade, late buyers panic, stops trigger, and price bleeds lower. But in a valve tightening move, pullbacks get absorbed. Why? Because physical buyers, the ones allocating for protection, not for a quick flip, step in. They don't care about a 3% dip. They care about getting exposure before supply tightens further. So, watch the next red day carefully. Does silver slice back through support, or does it hold, consolidate, and then push again? That's your tell. Pullbacks reveal whether a move is funded by fear or by greed. I'm not telling you to buy or sell. I'm showing you what to watch. This could reverse tomorrow. But if the valve mechanism is in play, weakness gets bought, and the next leg usually comes faster than most people expect. Now there's a second pattern that explains why this is happening at all. This one's about capital flow. I call it the safe haven rotation. Capital doesn't jump into hard assets all at once. It rotates, in waves. First, gold moves. It's the cleanest safe haven. Central banks hold it. Institutions understand it. Liquidity is deep. When confidence cracks, gold gets the first bid. Then silver follows. The lag isn't random. Silver's smaller and more volatile. It's harder to move size without slippage. So institutions, pensions, and family offices usually start with gold. They build protection there first. But once gold is already up, 10%, 15%, 20%, late capital looks around and asks a simple question. What gives me similar exposure without chasing? That answer is silver. Same macro drivers, same inflation hedge, same distrust of fiat currencies. But it hasn't moved as far yet. So the rotation continues. Gold stabilizes. Silver snaps. If stress deepens, you then see platinum, miners, and even certain base metals start to move. It's a sequence, not a straight line. Right now, we're in that second wave. Gold is already near highs. Silver just broke out. The rotation is active. Here's the trap. People see silver rip 8% in 2 days and think, I missed it. That's the wrong framing. If this is a real rotation, capital moving for balance sheet protection, not speculation, then the move doesn't end after one wave. Rotations compound, gold rises, silver catches up. Gold consolidates, silver extends. Then both grind higher together. You've seen this movie before. In 2010 and 2011, gold ran from about 1,100 to 1,900. Silver didn't move at first. Then it went from 17 to nearly 50. In 2019 and 2020, gold moved early on pandemic fear. Silver lagged for months, then ripped more than 100% in a year. Same pattern. The key isn't calling the top. It's knowing which phase you're in. Early rotation looks choppy. Gold leads, silver lags. Mid-rotation is where silver starts closing the gap. Volatility rises, but pullbacks hold. Late rotation is when both metals run together, premiums explode, and speculation floods in. That's the blow-off phase. We're not there yet. Premiums are firm, not vertical. Lease rates are tightening, not screaming crisis. Volatility is elevated, but not unhinged. This looks like mid-rotation. And again, the truth shows up on the pullbacks. If silver drops 5% and gold holds steady, the rotation is intact. Capital is still protecting. If both metals crater together and everything sells off, that's a different game. That's liquidity stress. Your job isn't to predict which one happens tomorrow. Your job is to read the rotation as it unfolds. Now, let's connect these two patterns. The liquidity valve explains how price is moving, fast and non-linear because of physical stress. The safe haven rotation explains why it's moving. Capital shifting from growth to protection. Put them together, and what you're seeing in silver right now makes sense. The valve is tightening at the same time, the rotation is accelerating. Pressure on pressure. Here's what that looks like in the real world. Imagine you're a family office managing $500 million. 6 months ago, you added gold as a hedge. It worked. Now stress is deepening. Tariffs, debt ceilings, geopolitical flare-ups, currency instability. You want more protection, but gold already feels crowded. So you add silver, multiply that decision across hundreds of funds and advisors. That's the rotation. But when that capital tries to turn into physical exposure, directly or through ETFs that require backing, it runs into the valve. COMEX warehouses see withdrawals. Mints struggle to keep up. Dealers widen premiums. The market doesn't have unlimited physical silver sitting on shelves waiting at spot. So, price adjusts. This isn't a conspiracy. It's not manipulation. It's just supply and demand hitting a bottleneck most people never see because they only watch price. Now, that pressure can release in two ways. One, price rises enough to slow demand. Buyers step back, specs take profit, the market resets. Two, volatility spikes so hard that even strong hands get shaken out. Margin calls hit. Forced selling breaks the rotation. Both are possible. You can't know timing, but you can watch structure, and that's where the signals come in. So here's the real question you should be asking yourself. Not, should I buy silver at all-time highs? The better question is, am I reading this as stress or speculation? Because if this is speculation, buying here is dangerous. Tops form on euphoria. But if this is stress, real capital rotating for real reasons, confirmed by tightening physical markets, then volatility is noise and pullbacks are information. The difference is everything. And the only way to tell is by watching the right signals. Here are 5 I'm tracking this week. First, retail coin and bar premiums versus spot. This is your ground level gauge. Go to a dealer site, APMEX, SD Bullion, JM Bullion. Look at Silver Eagles or generic bars. Check the premium. In a normal market, premiums stay flat or compress as price rises. In a stress market, premiums expand even as price rises. Right now, premiums are firm. If they start widening further, the valve is choking. If they compress, pressure is easing. Second is silver lease rates. Lease rates are the cost to borrow silver in the wholesale market. In calm conditions, they hover near zero. In stress, they spike positive because holders don't want to lend. They're rising now, not spiking. If they surge into the 2 to 5% range, that's serious tightness. You can track this on platforms like Bloomberg or specialist metals data sources. Third, the gold to silver ratio on down days. On red days, does the ratio rise or fall? If it rises, silver is weaker. If it falls, silver has stronger hands. That's a real-time sentiment check on the rotation. Fourth, exchange warehouse stocks. Watch inventories published by COMEX and the LBMA. Smooth flows are normal. Lumpy withdrawals signal delivery demand. Right now, flows are uneven but not extreme. Acceleration here would confirm stress. And fifth, volatility behavior on pullbacks. When silver dips, does volatility fade or expand? Fading volatility means healthy digestion. Expanding volatility means fragility. We haven't had a real test yet. The next 3 to 5% pullback will be revealing. From here, there are 3 broad paths. Continuation, where the valve tightens and the rotation accelerates. Pause, where the market digests gains. Or stress, where liquidity breaks and everything sells. No guarantees, just frameworks. If you're holding, size so volatility doesn't force your hand. If you're trading, respect momentum but don't chase it blind. If you're stacking physical, understand premiums are part of the process. If you're on the sidelines, don't let FOMO override logic. Diversification matters. Liquidity matters. Time horizon matters. Here's the bottom line. Silver breaking into record territory isn't the story. The story is why it's moving and how the market is behaving underneath. If you watch the signals instead of the headlines, you're ahead. Not because you predicted anything, but because you prepared. Markets don't reward predictions. They reward preparation. If this helped you see the structure more clearly, subscribe. Drop a comment and tell me which signal you're watching this week. And remember, the trap isn't missing the top. The trap is mistaking strength for safety. Stay sharp.